Well, Nick, welcome to the program. Thank you so much for joining us. In last week, of course, the Reserve Bank reviewed the OCR and increased by 25 basis points to 5.5%. Also signalled this could be the last OCR increase, which was that expected?
Yeah, thanks, Mark. So a 25-point increase at last week's review was pretty much expected by everyone. But calling time on further increases did come as a surprise. So a lot of people, economists, markets were expecting the OCR to reach a peak rate of around 6% later this year. And when the announcement was made to basically that it would be the Reserve Bank wasn't expecting to make any further increases, the New Zealand dollar and wholesale interest rates both actually fell. So the Reserve Bank seemed to have a bit of a different view from the markets as to where things were going. And also, interesting enough, the Minister of Finance weighed in before the announcement to say he didn't think further increases were necessary.
The Reserve Bank will have to balance factors when making its decision, of course, it always does. What were those in favour of calling it a day versus, more hikes?
Yeah, so those in favour of saying stopping now were that the global economy is continuing to be weak, affecting export prices, but also import prices for stuff we import. The domestic economy is slowing. Consumer and business confidence both remain low. Labour shortages do seem to be easing a bit on the back of higher immigration. And headline inflation anyway seems to be falling quicker than previously forecast, as are inflation expectations. Mm-hmm. And versus those on the other hand saying we should continue to, the Reserve Bank hasn't quite finished the job yet, would be that demand continues to exceed supply in the economy. The labour market remains tight with continued employment growth and low unemployment. Inwards migration has strengthened, which adds to demand in the economy. House prices aren't falling as they were expected to be falling. And fiscal policy is certainly less contractionary than what they're expecting, and some might argue more expansionary. And core inflation, which is what the Reserve Bank is really probably should be more concerned about, the headline rate, that remains stubbornly high.
When does the Reserve Bank sort of expect to be able to cut rates, do you think?
So according to its forecast and its monetary policy statement, they seem to imply the OCR will remain at its current level until the third quarter of 2024. So that's well over a year from now. And then it's expected to be able to be reduced.
So the Reserve Bank's been hiking interest rates to address this high inflation, this stubborn high inflation. How is inflation affecting farmers? I mean, farm inputs inflation is still higher than consumers generally, isn't it?
Correct. So the Farm Expenses Price Index, which Stats NZ puts out every quarter, the March quarter, which is the latest data, had the FEPI, which we call it, the Farm Expenses Price Index, increasing by 11.7% for the year. Now that's a bit down on the previous quarter's annual increase of 14.6%, but it's still well above the CPI's annual increase of 6.7%. Part of that discrepancy, if you like, is explained by interest costs. So in the FEPI, interest rates or interest costs are up 52% compared to the same time last year. The CPI actually excludes mortgage interest from its calculations. So the gap will be a bit narrower, but it's still higher even so.
So the budget was delivered the week before this OCR review last week. So what did the Reserve Bank make of the fiscal policy, I guess, impact on inflation?
Yeah, so the Reserve Bank's response to the budget was quite bland, really. It sort of said, on the one hand, that it thought that the increase in spending over the next year would be adding to demand, and would therefore be an additional fiscal stimulus. And basically policy generally appears to be what they called less contractionary, or what I would say more expansionary, than what they were expecting back in February. But it also said that beyond next year, i.e. after 2024, according to the fiscal forecast, it seems that it might be more contractionary. So it's looking more at the longer term. I'm not so sure about that, to be honest. So if you look at the numbers in the budget, government debt's going to be up to $215 billion by 2027. That's up from $135 billion now. Yes, it's true that the increases in core Crown expenses, annual increases, are looking to be more moderate in the years beyond 2024. But if you look back over previous budgets, that doesn't take into account the operating allowances, which can add billions to each year's spending. So I'm not so sure that it's quite so contractionary as the Reserve Bank is maybe hoping. Let's put it that way.
So the next OCR, or the monetary policy statement, will be on 12th of July. Do you think the OCR will have to be lifted, even though they say we've reached a peak? Do you think it might not go that way?
Yeah, I think probably in July it will probably stay the same. I don't think there'll be enough new data that comes out between now and then to prove the Reserve Bank wrong. That said, I do think if say particularly the inflation and employment information comes in stronger than expected after that review, then we could see an increase in August, or if not in August, maybe in November. And November, of course, is after the election, so the Reserve Bank would be able to do that without being accused of getting into the politics of the election season.
Yes, having to remain independent, of course.